In a bustling engineering consultancy, the focus is naturally on blueprints and concrete. But beneath the visible work lies a complex, invisible payroll system. The moment a firm hires its first employee, a strict legal clock begins ticking. Within 21 business days, the practice must register with the South African Revenue Service. The law requires the firm to deduct the exact tax owed directly from employee wages. If there is a shortfall, the employer becomes personally liable for the missing funds. Payroll in the built environment operates as a rigid system of legal and professional liability. To manage this liability, firms must account for three core tax components. The primary pillar, PAYE, settles tax progressively as employees earn. The UIF pillar requires a 1% deduction from employees, matched by employers, up to a statutory cap. The SDL pillar triggers a 1% charge when annual payroll exceeds 500,000 Rand. These three requirements form a non-negotiable structural load. Every consulting firm must calculate and carry this weight accurately. Down at the entry level of the organizational chart, young quantity surveyors and junior architects bring their own specific variables to the system. Hiring qualifying young professionals allows the firm to claim the Employment Tax Incentive, or ETI. This incentive rewards the stimulation of youth employment. As the diagram illustrates, it allows the firm to legally reduce its total PAYE liability. By tracking this properly, the firm turns standard compliance into a direct cash flow advantage. Out on a muddy construction site, the rules change entirely. Here, firms rely heavily on independent contractors. Standard employees fall under the Basic Conditions of Employment Act, with predictable monthly deductions. Independent contractors operate outside this framework. Misclassifying a worker on a major government contract, like an NEC-3 appointment, exposes the firm to severe financial penalties and retroactive tax bills. At the absolute top of the hierarchy, directors introduce another layer of complexity. Because their remuneration fluctuates with the firm's performance, they are classified as provisional taxpayers. Firms must track a director's earnings meticulously, issuing IT3A certificates for any taxable benefits where standard PAYE was not deducted. An individual's specific role permanently dictates the mechanical tax logic applied to their earnings. Every month, the data from the candidate, the contractor, and the director must flow into a single master declaration, the EMP 201. The timeline for this declaration is absolute. The data, along with the corresponding funds, must be transferred to SARS by the 7th day of the following month. The final calculation is straightforward. Add the PAYE, the UIF, and the SDL, then subtract the earned employment tax incentive rewards. This resulting number is the firm's total liability, and meeting it is required to keep the practice operating legally. At the end of the financial year, the firm faces the ultimate audit of its own data, the EMP 501 reconciliation. This requires the firm to perfectly balance 12 months of EMP 201 declarations against the actual payments made to SARS and the individual tax values assigned to every employee. The logistics of submitting this data depend on the size of the practice. Standard e-filing channels cap submissions at 50 certificates. Once the numbers balance, the firm generates the final employee tax certificates, locking in each staff member's tax status for the year. The EMP 501 process serves as a rigorous stress test of the firm's internal record-keeping and operational competence. When the total tax values on those individual certificates fail to balance perfectly with the monthly EMP 201 declarations, the system breaks down. SARS responds to this discrepancy by triggering an estimated assessment and issuing a notice of excessive liability change. When a firm tries to pay its way out of this failure, the debt allocation rules are punitive. Payments are routed to cover penalties first, then interest, and only lastly applied to the actual tax owed. To resolve the issue, the firm must track back through a year's worth of records to find the error, file cancellations, and submit a revised EMP 501 to balance the ledger. In the built environment, a consulting firm's payroll is a strict legal framework governing labor, taxation, and ultimate professional accountability.